This is going to be a fantastic piece. So are you ready? Let's take a look at this piece. I'm going to call this piece, how often do V bottoms happen?
V bottoms.
V bottoms. How often do V bottoms happen?
More than V tops.
This is true. That's true. I think you're gonna like where I'm going with this. This is a very different. There's gonna be a little surprise here, I think, in the middle of this. I'm sorry, Tom. I came in kind of announced. Do you want to read the slides and I will kind of
No, you can. You seem very. No, you're good. Go ahead.
Okay. Well, since the capitulation in equity market that started on August 1st, the markets have fully recovered their losses as of yesterday, 6% pullback in just 11 trading days. You can argue it was yesterday or 2 days ago. It's a hair difference. So point is very, very short-term pullback, very short-term recovery. So this is what we call a V-bottom. So let's go to the next slide. We call this a V-bottom or a whipsaw. I think the V-bottom is more of a. Did you call it V-bottoms in the trading floor, or is that more of a new term?
It's a new term.
Okay, so that's kind of like the Gen Z term, and you guys call it a whipsaw.
Yeah, I'll give that to you.
All right. How often have we seen these type of market moves in the last 20 years? That's the question. So if I gave you a number, right, a single number in the last 20 years, how many times have you seen a move very similar to the one we just had just now?
How often? I would say once every year or 2 years. Pretty often.
Okay.
I would say 5 times.
5 times total?
No. Per year. How many years you're going with? 20 years?
20 years.
Well, but we would have a lot more.
Hold it. You're saying in 20 years?
Yeah, in 20 years.
Oh, in 20 years, that kind of a V bottom, because you don't have. I would say we've probably seen 6 or 7.
6 or 7.
Oh, I'm going to take the over. I'm going to say like 25. Depending on how you define what a V bottom is.
So that's going to be the theme for this set, because it's very easy to cherry pick your data and look at like, oh my gosh, this was a V bottom. So obviously, let's see how many times this happened, even though each one is very unique and defined differently. So I'm going to define it a certain way, and then we're going to actually look at the overarching point of the segment, which is not really looking at V bottoms, but in general, why you shouldn't look at sell-offs as V bottoms in general. Okay, so since 2004, observe the number of occurrences of a full V bottom. We're going to define it as a certain percentage pullback with a full recovery in a certain number of trading days. And the way we're going to define the certain percentage and the certain number of days is the following. We're going to do 5%, 10%, or 15% pullback and recovery within 10, 15, or 20 days. 10, 15. I'm sorry. This is supposed to be 5, 10, or 15 days, not 10, 15, or 20 days. I'm going to change it in this next slide because that was my mistake. 5, 10, or 15 days. Okay, so that's basically 1 week, 2 weeks, or 3 weeks. Which, if we look at basically what we just saw just now, it was about 2 to 3 weeks. Okay, so 5, 10, or 15 days. 5, 10, or 15% pullback recovery within those. Okay, so 5% V bottoms, which is the one we just had. It was 6%, but it's hair of 5%. If you look at close to close data, was by far the most common. There were just 42 occurrences in the last 20 years that were similar to the one we just had. So 40, which was kind of what you said, Tony. It was more common than you think. And obviously, if you go to the 10% ones, it's very, very rare, right? There was, I think, and some of these are in 2020, so there's a lot of like clustering in this data set. But if you look at the stuff we had last week, that's kind of typical of what you typically see, and those are the most common. So about 40, call it 40, 45. Are you surprised by those numbers? Anybody?
I'm not, but I think Tom is.
I'm not really. No, now that I look at it, no.
Okay, now let's go to the next slide, because I think this is going to be interesting. Here is where it gets interesting. When you look at all the market sell-offs from their all-time highs, what's the average time that it takes it to recover? So let's say I gave you a different question now. How many 5%, 10%, and 15% pullbacks, or what's the average time it takes to recover from a 5, 10, or 15% pullback? And if we look at it from the context of a V-bottom, you're like, oh, well, okay, V-bottoms happen kind of often. So I'm going to say 5% pullback, maybe it takes it 3 weeks. 10, like a month, 6 months to recover. But the reality of the situation is it's a lot longer. The average pullback of 5%, 10%, 15% takes 171 trading days, 463 trading days, and 565 trading days respectively to recover, which is totally different than what you'd expect if we're showing you a data set of V bottoms, right? Because those are very kind of sudden, and the typical is a lot longer. Does this make sense? Because I'm kind of going to I'm kind of leading you guys into a place where I'm trying to basically reinforce the concept of market randomness. Because if you look at these V bottom scenarios, which you are essentially cherry picking the data, how many times we had a full sell off and recovery within a certain number of trading days, you can only get those if you specifically say, okay, within 20 days or within 30 days or within 10 days or whatever your threshold is. But when you're just seeing the sell-off for the first time, you don't know what the next 10 or 15 or 20 days are going to hold. All you know is that there's a 10% sell-off or a 5% sell-off, right?
Sure.
So the whole point of this is to say, okay, you have a 5% sell-off. What's the average days it'll take to recover historically in the last same data set, 20 years, 171 days. So it's funny because even though we have a handful of these V bottoms, it's so ineffective to actually bet on that happening because the average is like half a year or even close to a full year. And here's the best example I can think of this. If you go to the next slide, this is like classic. Here's SPY. This chart is taken the first month, basically November, December, and January, 2021, 2022. So this is November 2021, December 2021, and January 2022. Now, January 2nd marks the high of the market, right? You have a 10% sell-off from January 2nd to January 24th, okay? Now, you think, how long is it supposed to take to recover? Well, you don't know the rest of the chart. All you know is what you see in front of you. So let's go to the next slide. And obviously, as we know, it took over 500 trading days for that 10% sell-off to recover because you have no idea what's coming next. Now, of course, if you have a V bottom, you can say, okay, how many individual one of these V bottoms do you have in the last 20 years? But when you're trading, that number is actually irrelevant because how the heck do you know that this next sell-off is going to be a V bottom and not something that looks like 2022 and 2023 that takes over 2 years to recover?
And
I had no idea that, you could look at it that way. I mean, there's a couple of takeaways I'm getting just off the top of my head while you're saying this. I mean, so you're not missing anything by missing the bottom on this V bottom. You know what I'm saying? Like,
of course not.
Right.
No, what's even more important or more interesting is that
you scalped your NASDAQ futures?
No, I'm pissed about that too. I'm pissed I didn't get filled on my order, but that's something different. What's more interesting is that this gives me more reason to be even more bearish here because what we just saw is so rare that how can you not fade those up moves in those short periods of time after that kind of reversal? Like it only makes sense.
Right. And this is the concept in statistics we call the counterfactual, which is basically saying, okay, if you look at a V bottom, you have a defined entry point and a defined exit point. So by its nature, it's a descriptive thing you can take from the markets, but there is no prescription in there. There's no takeaway from there. Because if you know the entry and the exit point of a V bottom historically, when you're going into one, you have no idea what the exit point is. And the average is, like we just said, 1 year, 2 year, even 3 years at some point to recover. So when you have these V bottoms, there is absolutely no prescriptive takeaway that you can get in the middle of one because the average, again, is like 2 years for it to recover. So how do you know this one's going to be a V bottom? You don't. In fact, very seldom do you have those, right? So it's almost like when you have these things that happen, you have to look at the counterfactual, which is what could happen if we didn't have this bottom. And the answer is something like 2022 or something like 2008, which I'm not talking about the actual size of the sell-off, but the time it takes to recover from those sell-offs is very rarely 2 weeks or 3 weeks. And we usually, even within think about it this way, in 2023, we had a pretty bullish market, but if you're looking at the recovery point from the highs, we were still well off our highs. Even in a bull market, you can consider 2023, right? So it's just basically saying you can't mix these statistics together. You can look at those V bottoms, you can say they're interesting, you can say, wow, that's crazy, but there's no way you can take away a trading technique or a takeaway that you can actually implement in your day-to-day trading because you have no idea how or when they're going to happen.
Yeah, of course. And that takes us to getting back to Chris's whole discussion just a few minutes ago as well. That's why it's so difficult for me to this is no different. There's the same level of randomness that you're applying to this discussion. You can apply to any discussion about the Fed, any discussion about, any market movement. Like, that's the beauty of this. So really, what are you looking at as a trader? I mean, how can you ignore what you perceive to be price extreme in favor for some argument outside of that, knowing that everything else is so random?
Right, exactly. Because if you have a 10% sell-off, the only thing you can really look towards as a prescriptive or a helpful statistic, it takes about 400 trading days to recover. That's more tangible than saying that V bottoms of 10% took, there were 7 of them or 10 of them or whatever, because that gives you no information about how to actually play the market. Even though there are good talking points, they're covered by the media, all the stuff, there is no tangible takeaway to it. V bottoms are categorized as short-lived sell-offs that happen roughly 40 times in the last 20 years if you're talking about 5% sell-offs. Although uncommon, we cannot categorize these in the same way we do normal sell-offs because we don't know that they will continue or not. And that's what's called the counterfactual. When you see the 5% sell-off, you have no idea if that's the bottom or not, because the average is a lot longer than the frequency of these V bottoms. And for the average 10% sell-off, we saw an average recovery time of 1 year or longer. And I think that for us, if we're trading this tactically, we can't look at some expectation of quick recovery, because that's just like, we have these little pockets of interesting stats in the market, but there's no way we can point to one and say, oh, we're in a 5% sell-off, there is a good chance this is a V bottom. There's no way we can actually statistically play for that. So
there's also it brings up one other interesting use case or discussion case, which is when you have a short position on that's like static. Let's say you sell stock or you sell a future or whatever it is. For all the reasons that you've talked about in this sell-off, not knowing how long it goes, it's really hard to know where to get out. So most people that have a static position on, like, you beat yourself up over wherever you cover it, because if it keeps going, you're like, I can't believe it covered. And if it turns around and goes back up, you're like, I can't believe that I didn't cover. Like, you can't win.
Right.
You cannot buy the bottom, so you can't win. So
right.
The alternative, which is using some option strategy where you either manage at 50% or at 21D, gives you an automatic out that you don't have to question.
Exactly. And even by the nature of the expiration cycle, you already have the time that you exit the trade.
Yeah.
Which for a lot of people is very helpful, especially when you have these huge whipsaws that you now question, I can't believe it. I fall into that trap sometimes too. That's why I trade options.
Everybody does. Right.
So
good
anyway,
job.
hopefully this was a good discussion as opposed to strict study, but